Welcome back, everyone. I'm Jordan Giesecke, and this is The Limiting Factor. In the past few weeks, there's been excitement building around the idea that SpaceX could rent hundreds of billions of dollars worth of terrestrial data center compute in the next year or two. That could trigger a massive increase in its stock price and market cap well before the space-based compute business takes off. That appears to fly in the face of what I said in my last video, which is that I didn't think SpaceX would be cash flow positive enough in the next couple of years to warrant a significant stock price revaluation. So, was I wrong? Or is it just another case of Schrodinger's valuation, where two people can look at the same company and assess its value differently? Today, I'll walk you through the details, and while I'm at it, also provide an update on the forecast I made in my data center video from a year ago. Before we begin, a special thanks to my Patreon supporters, YouTube members, and Twitter subscribers, as well as Rebellionaire.com. They specialize in helping investors manage concentrated positions. Rebellionaire can help with covered calls, risk management, and creating a money master plan from your financial first principles. Let's start with some background. In May of last year, Elon stated that Colossus 2 would eventually reach 1 million GPUs. As a result, I made a video estimating to achieve that would require 3 buildings. Each building would have a 1 million square foot floor plate and would have 3 floors, for a total of 3 million square feet per building. Each floor would house 110,000 GPUs, consuming 300 megawatts of power. Each building would contain 330,000 GPUs and consume about 1 gigawatt of power. Multiply that by 3 buildings to hit 1 million GPUs and a total power draw of 3 gigawatts. Let's take a look at what actually happened. First, also in May of 2025, Elon estimated that they would have 1 gigawatt of compute, or around 330,000 GPUs deployed at the Colossus 2 site sometime between November of 2025 and February of 2026. That turned out to be correct, and in January, Elon confirmed that they had achieved 1 gigawatt. Second, Elon said that Colossus 2 would reach 2 gigawatts of compute after adding their third building in Memphis, which is the second building at the Colossus 2 site called Macro Harder. That matches my estimate that each building could hold around 330,000 GPUs at 1 gigawatt each. However, it ended up being organized differently than I expected. Rather than erecting 2 additional buildings adjacent to the initial Macro Hard building at the Colossus 2 site, most of that land was used for cooling and power equipment. Instead, SpaceX bought the building across the road for the Macro Harder building. Third, I said that based on a reasonable learning curve, that they could have 1 million GPUs installed by the second half of this year. Given that we only know of 550,000 GPUs being delivered for Colossus 2, it looks like they haven't been able to maintain that installation cadence. Either way, those 550,000 GPUs were probably fully installed and powered up by April. That's because Elon stated in this post that Colossus 2 would reach 1.5 gigawatts in April, which is close enough to my estimate of 1.7 gigawatts of power required for 550,000 GPUs. As for the remainder of SpaceX's compute, the Colossus 1 site has about 230,000 GPUs, and they're mostly older H-series GPUs that probably use a total of 300 megawatts of power. So, the grand total for power consumption between Colossus 1 and 2 is around 2 gigawatts. In the past month, SpaceX has started to rent out a portion of that 2 gigawatts of compute. They rented 220,000 GPUs at Colossus 1 to Anthropic for $1.25 billion per month, 110,000 GPUs from Colossus 2 to Google for $920 million per month, and $150 million worth of GPUs to Reflection, which I'd estimate was probably 10,000 to 15,000 GPUs from Colossus 2. That makes for a grand total of $28 billion per year for 340,000 GPUs, which is nearly half of SpaceX's total compute capacity in terms of GPUs, and in terms of power is 600 megawatts of their 2 gigawatts. This also tells us that so far, SpaceX is renting out its older compute first, the H-series GPUs and some of the first GB series. That's relevant because it may indicate which GPUs SpaceX is likely to rent out next and at what price if they expand their data center rental business. On that note, SemiAnalysis estimates that in total, SpaceX has roughly 4 gigawatts of power generation installed or underway in Memphis for their Colossus sites. If SpaceX is already using about 2 gigawatts of power, that means there's enough runway for them to double their compute power in Memphis in the next 12 to 18 months. So if they continue to rent out about half of their compute to other companies and use half for themselves, 2 gigawatts each, the current 2 gigawatts of compute capacity could be fully rented out. That would mean renting the remaining 440,000 GPUs at Colossus 2 for $3.7 billion per month, resulting in a grand total of $72 billion per year. That's a serious amount of cash flow by the middle or end of next year. However, how much would that additional 2 gigawatts of compute cost? According to Gavin Baker, 1 gigawatt of compute currently costs about $60 billion. So installing 2 gigawatts of additional compute in the next 12 to 18 months would mean $120 billion of cash going out the door, which dwarfs the $72 billion of revenue SpaceX would be generating from their 2 gigawatts of existing compute over a similar time period. So yes, it is correct that there's billions of dollars of compute revenue inbound for SpaceX. But what I was saying in my last video could also be true, that SpaceX may not be seriously cash flow positive for another couple of years due to capital spending. And generally, the stock market usually pays much more attention to positive net cash flow than revenue, because positive net cash flow signals a sustainable business model. The stock market doesn't always do that, and profitability is often a major turning point. But the point here is that it's worth considering more than just revenue. Where could I be wrong about SpaceX's near-term cash flow potential? First, to keep it simple, I only looked at data center rental, which, as Brian Wang shows here, is just one of SpaceX's many businesses. Let's look at 2 others. First, SpaceX's Starlink business is also growing rapidly. But if they're investing hundreds of billions in terrestrial data centers, it doesn't appear that the Starlink business will generate enough revenue to make the company significantly cash flow positive in the next year or 2. Second, SpaceX's AI coding software, Cursor. For me, this is the real wild card. If Cursor took off, it could be a much more profitable use of their data centers, and it's a business that could see explosive growth over a 1-year time frame. For example, Anthropic's coding software has gone from a run rate of around $9 billion at the end of 2025 to likely more than $100 billion by the end of 2026. However, while it's certainly possible for SpaceX's software business to see similar growth, Anthropic won't be standing still, and neither will other AI companies. That means if the AI coding software market remains competitive, it may dilute the potential of SpaceX to see a similar 10x or more growth rate in the next year from Cursor's current $4 billion annual run rate. Moving along, Brian did of course include other businesses in his forecast, but I think those businesses are either more speculative, lower likelihood, and or have lower revenue potential in the near term, which is why I'm not covering each of them. It's also worth pointing out that although the $108 billion GAAP net gain figure at the bottom of the spreadsheet may include depreciation expenses, the depreciation would only be a fraction of the full cash outflow or actual cash spending in 2027. That is, despite a gain being shown here, the cash flow could still be negative if they spend $120 billion on data centers. The third way I could be wrong about SpaceX's cash flow is if they rent out much more than half of their GPUs and/or charge a much larger premium for the newer Rubin GPUs that are expected to be installed next. Those two factors combined could increase their rental revenue to far beyond $72 billion and fully cover the $120 billion of capital costs for 2 gigawatts of additional compute. The question is, if SpaceX massively increases its revenues through rental income or through software services like Cursor, would those businesses generate enough positive cash flow to cause the stock market to significantly revalue SpaceX in the next year or two? The honest answer is that I don't know, but no one does at the moment, probably not even SpaceX or Elon. That's because there's so much uncertainty and so much competition in the AI space. Just a year ago, people would have said that OpenAI is crushing the AI software space, but they've suddenly been surpassed by Anthropic. So, although it is possible that SpaceX could be generating the hundreds of billions of dollars of revenue in the next year or two that some analysts are estimating, those estimates are low certainty. And if those revenues do pan out, most of the analysis I've seen doesn't seem to factor in costs for capital equipment that could result in SpaceX being cash flow negative, making a significant upward revaluation in the stock price low probability. As a side note, one concern that's frequently raised around AI data centers is how they'll be financed. I don't share that concern. Why? First, SpaceX had no issues raising over $80 billion in their IPO, so they don't have any near-term risks of running out of cash and could likely go back to the market for more. Second, customers like Google that are desperate for compute could help fund data center expansion with their tens of billions of dollars of positive free cash flow. However, I view that as a lower likelihood scenario. That's because it could come with obligations, and Elon typically tries to avoid business entanglements unless it's necessary because it can limit his strategic options. For example, as we've seen with SpaceX's data center deals, they all include termination clauses in case SpaceX needs to redirect that compute to their in-house products, like Cursor. Third, in a worst-case scenario where the capital markets got extremely tight, it would only slow the growth of SpaceX, not stop it. That's because they have tens of billions of dollars already coming in from data center rental, along with profits from the Starlink business. That is, instead of going cash flow negative to build out infrastructure, they'd just build more compute as cash came in. In summary, the terrestrial data center business alone for SpaceX is a multi-trillion-dollar opportunity, and the commentary that it could explode in growth over the next year is spot on. However, the question I have as an investor is, when will that business become cash flow positive? That's because there's going to be a lag between when the hundreds of billions of dollars of hardware is purchased and when it's brought online. And even after it's brought online, the return on that invested capital doesn't happen overnight, but rather slowly accumulates for each month that data center is rented out. So, if the intent is to grow the data center business rapidly, it creates a high likelihood that it will be cash flow negative. For a long-term investor, that's a positive because it builds a foundation for future profits and allows you to build conviction that the stock price will eventually see a massive revaluation upwards. But if you're a more active investor, you'd ask the question, how many months or years away is that? Because if you're looking at every stock in the stock market, there are others that have already passed the deep investment part of their growth cycle and have a clearer path to profitability. And to be clear, what I'm talking about here isn't timing the market or stock trading. It's about keeping a close eye on the companies you're invested in and understanding where they are in their growth cycle. It usually takes years to go from deep investment to revenue to free cash flow positive. You can invest at any point, but what suits you as an investor? So, in my view, other commentators are providing a valuable service by calling out the revenue potential of SpaceX's terrestrial data center business. With that said, based on the information we have right now, it looks like that revenue won't make SpaceX significantly cash flow positive in the next 6 to 12 months. I could be wrong, but that's why I'm going to keep a very close eye on SpaceX and adapt as the information landscape evolves. And when SpaceX appears to have comparable or better potential returns than other stocks in my portfolio on a 1 to 2 year horizon, I expect to invest. And to be clear, that won't necessarily happen with a significant change in the financials. It could happen much earlier if the stock fell to bargain basement prices. As always, this isn't investing advice, and do your own research. Please consider supporting the channel with the links in the description, which now also includes a referral link for Signature Solar. If you use that link to purchase home battery or solar equipment, it nets me a small percent-based credit, but that can add up on a large purchase, and it really helps the channel. On that note, a special thanks to my YouTube members, ex-subscribers, and all the other patrons listed in the credits. I appreciate all of your support, and thanks for tuning in.